Good morning. I'm Adam Luke, Head of Finance here at Level 39, and it's my pleasure to welcome you all this morning for our panel session, which will be talking about the digital revolution, challenger banks, and the evolving fintech landscape. Joining me today are two panelists who are at the heart of the UK's tech ecosystem. Today's panel is all about challenger banks and the wider fintech vertical in 2021. How are businesses responding to the pandemic, and where will investors, entrepreneurs, and innovation experts in the traditional banking space be looking next? For companies across the economy, the pandemic has caused untold disruption, and many companies are facing very serious hurdles today as they plot a path to recovery. Yet for many of the challenger banks and fintechs have responded to widespread change and are seeing an uptick in customer acquisition and ultimately growth. In part, this has been driven by fintechs moving more aggressively into the business banking space. And we saw several fintechs signing up to the government's CBILS, Corona Business Interruption Loans, and BBLS, Bounce Back Loans scheme to SMEs. More broadly, the fintech sector at large recorded an impressive figure, attracting $4.1 billion in fresh funding for UK businesses. It is apparent then that the promised change offered by fintechs might be taking hold to a greater extent than ever before for consumers and enterprise customers alike. So with this in mind, I would like to invite our guests, David Hall, Chair of the Venture Capitalist Trust Association and MD at YFM Equity Partners, and Sean Hunter, CIO at Oak North, onto the virtual stage. Welcome, David. Welcome, Sean.
Thanks, Adam.
I'll ask each of you to briefly introduce yourself. David, why don't you start?
Yeah, hi, I'm Dave Hall. I am a Lancastrian by birth, working for a business that is headquartered in Yorkshire, spending some of my time in London. I represent both YFM, which is an early stage investor, and the Venture Capital Trust Association. Venture capital trusts have about 5 billion in total under management and tend to invest sub 20 million. So they're in the early stage scale up part of the market.
Hi, I'm Sean Hunter. I'm the CIO of Oak North. For those of you who don't know, Oak North represents both halves of this conversation today. So we are a challenger bank in the UK and a fintech that licenses our technology outside the UK to other banks. And we're dedicated to trying to solve the problem of SME lending. So trying to help entrepreneurs and small business owners get a better experience when they go to a bank for debt finance.
Great. Thank you all for joining us today. Before we get started, if you'd like to get more involved in the conversation on Twitter, please do so using the hashtag Level39. That's hashtag Level39. And as a reminder, the format of this morning is a 45-minute panel discussion, open up to audience Q&A for 15 minutes. Throughout the session, please do share questions using the Q&A box. We'll come to them at the end. There's also opportunity for virtual networking following the Q&A, which I encourage you all to stay for. Right. Okay, let's get started. To kick things off, I want to wind back and talk 2020 as the year for fintech. Sean, we saw last year more people started to use digital banks than ever before. Do you think this shift is permanent?
Yeah, I do. And I mean, I think it's an example of a lot of things where, the sort of inconvenience of the lockdown and the social changes and everything have forced people to make changes that previously they might not have done. And so a lot of things in life have become digital. Trivial example is contract signing. Like there are a lot of companies that previously used to insist on a wet signature. Now they're happy to take an electronic signature on a contract just because physically trying to do these things is difficult. And I think challenger banks, because they're designed from birth to give a fully digital experience, it means when you aren't able to physically go to a branch, it's actually much more convenient for people. I also think the fintech landscape more generally has evolved in consequence of this. And, a lot of fintechs who work with existing banks are actually seeing their moment now, because all of a sudden, those banks need help, they need innovation, they need a more digital experience for their customers.
Right, that's interesting. I think from my perspective, in the offset, I thought cash would be more prevalent, but in fact, it's actually sped up the adoption of contactless payments from consumers alike. That was really interesting for me. I expected a bit more opposite, but that has been an interesting take for me. And what do challenger banks and the likes need to do then to retain these customers going forward?
Well, one of the things is, I think a lot of challenger banks, they need to demonstrate that they've got more than just a fancy app. Because if you're competing against, the likes of, pick a trivial example, Barclays, HSBC, Lloyds, the big banks, Santander, those guys have massive IT budgets and so on. Yes, they're not as fast moving as the challengers, but if all you have is a good app then they're going to catch up with you. So having a distinctive offering, I think, is very important. Like for us, we try to give entrepreneurs a very different type of experience than they would get from a big bank, because we take them seriously. They're our lifeblood. We try to be a real partner to them, etc. And I think, that niche is likely to be more sustainable because there are structural reasons why this is difficult for a big bank to do. So I think challenger banks need to demonstrate that they can't just disrupt. They've got to offer something distinctive.
Right, that's very interesting there. David, last year we also saw the government utilise challenger banks for the first time to help with the distribution of the bounce back loans and the like. What does this indicate about the sector, and how else could the government tap into fintech to help businesses and individuals right now?
Yeah, it's a good question. I think there was a lot of change last year, and it feels like, not just because I'm getting very used to the wallpaper here, that you lived sort of 5 years in one. I think that's like you said, that's accelerated an awful lot of trends that existed, of which the digitization is one, but it's not the only trend. You see the acceleration of the death of the high street. And I think that's changed people's perceptions and in people's minds. So I think the challenger banks themselves stepping in and becoming part of CBILS was an acceptance, if you look at it by the government, about where the touch points were with the economy to distribute something quickly, knowing that the existing mechanisms were not going to be sufficient in themselves. The existing banks weren't set up to. So the first thing, I think, is a recognition there that challenger banks have now got a place in the distribution channel, and therefore in the government's psyche. In order to be able to do that, I think that probably there are two things that are at the heart of kind of where the newer banks are making an impact, which is in part in relation to where the existing banks are. So if you think of where your relationships with your banks have been falling down, they're in two ways. One is they're not necessarily providing you the direct service that you want, which is your digitization. They can't use the app. It's not open. It's still operating call centers, and it doesn't speak the language, right, that a lot of people need, and particularly those who've grown up in an app-based environment. But the second thing that's lacking, both for the retail customer and for the small business customer, is the death of the relationship. So what happened post 2008, 2009 with banks was they got driven towards credit and risk control. And in doing that displaced the role of the individual contact. They get the classic computer says no, the computer that you had no interaction with. So those two things together, where the challenger bank opportunities really come from, is to reset the dial over that relationship with the consumer. So, and if there's one thing that you can say, fintech is something that Sean said, that there's a lot of focus on the technology, which is obvious a need. But there equally needs to be a focus ultimately on your end customer, and how do you develop a much better relationship with them, both at the small business and at the retail side, through a digital connection. And I think that's the real challenge, but also the fantastic opportunity that challenger banks have got, because there is just a massive disconnect. And I go back just from the last point, I go back to my 89-year-old father-in-law who's a farmer. You talked about cash. He's been struggling to bank his checks because he's been shielding and has to stay in. Yeah, my 89 father, will he ever change? Yes, he has to. He's now got a scanner. He scans in his checks and it's uploaded. He's not going to go back to the other way now. So there are just some things that force people into change. And that, again, is another opportunity.
Yeah, I couldn't agree more. And I think that the thing you pointed out, which I think is so important, is there's a kind of an idea that, or used to be this idea that technology was going to just make banks more efficient, sort of save cost. But in actual practice, technology represents an opportunity to serve your customer better. At Oak North, for example, we bring, pre-crisis, we used to bring the borrowers into our credit committee so they would meet in person with the people who were making the credit decision, and present their business in person, which was very, very different from how normal banks work. And part of the reason we were able to do that is because we have a bunch of technology behind the scenes. So the credit committee kind of know all the things they want to ask. They've got all the analysis ready and so on. So they're not kind of fumbling around, frightened, so they're happy to meet the client because they know they're going to understand the client's business and ask intelligent questions and so on. So the client isn't going to think, oh my God, my bank doesn't understand me at all. And it changes the relationship with the bank. And I think that's very important. I also think it's worth acknowledging that governments are not designed to move fast. And with CBILS specifically, like the government intervention needed to be very fast, and it was tremendously helpful. I think using challenger banks to do some of the distribution was very important because actually it meant that the funds were available faster to these businesses who had a very, very desperate short-term need, especially at the beginning of the lockdown. I think during the lockdown, my brothers own a small business. During the lockdown, they got kind of used to how to operate in the lockdown, with very, very much reduced customer demand. But especially at the beginning, there was a really desperate short-term need for businesses to get funding.
Right. It's a good point, David, about the opportunity and how it's a opportunity for challenger banks to get more involved. And it's a good starting point, I think, what happened last year with CBILS. And Sean, great insight from you, as Oak North was one of the handful of challenger banks that was accepted onto the program. So I'm sure you saw firsthand, front row seat of how to bring the two together, working government and challenger banks, and the acceleration hopefully will solidify and the opportunity to grow for more challenger banks and the like to get involved in these schemes going forward. Moving on to financial services and investment. David, as I mentioned earlier, UK fintech attracted a great sum of investment capital in 2020. What does the sector need to do to ensure it continues to attract record level of investments moving forwards?
Oddly enough, I think the UK is always cited as having one specific structural advantage to start off with, which it is probably the leading place in the world where the financial center and the tech center are in the same place. Even in the US, one's on the East Coast and one's in the West Coast. And what that leads to is the benefits of clustering. It means all the people who are operating there, they go to the same places. They used to go to the same places, used to go to the same pubs and restaurants, not so much in that. But there's a big exchange of ideas, and it happens, and it's an osmosis. So if you start with, there is an inherent structural advantage that probably the only other place that comes close, usually that's cited, is Singapore because of the size of it. But it also has a big trading centre, and we'll come on to Brexit in a minute as to what to do. So what fintech has effectively got, if you start off, that is the melting pot in which you have, then what you've got to be able to do is, I still think at the end of everything, it is quite interesting. I suppose I've been investing now for about 40 years, and it doesn't really matter what the next revolution was, but there was no internet when I first started investing. And and what sometimes is forgotten when there is a new leap forward in whatever it is, that whatever the tech is, or the new service, or the evolution or innovation, right, it's got to put at heart the customer, your customer, whether that's a business customer or whether that is, you know, a retail customer. So the one thing that I always plead, because I think, like I said, it's great. There was 4.1 billion last year invested, but there's always more that you can do, and there's always some people who will be disappointed in that. And the reason that you can take more up is when you put your customer centric. So particularly think about the way that businesses are evolving now. So that B2B interaction, as it now is, business to business interaction, now puts people much more at the heart of that than you're dealing with a corporate. So try and think of exactly what your customer solution is. And what you see is not just the challenger banks themselves drive various. Off the back of that hangs an awful lot of different, you know, different needs and tools, whether the banks are moving their data differently, or whether they are capturing data, whether you've got business analytics that are coming into it. So all of those things, as a bank, those challenger banks are desperate to know more about the customers, and that is where, if you think about that, that's where ultimately, if you solve either a customer's problem or give them something that they need and want, you will find that you will scale and grow more of it much more quickly. So if you put that at the heart, and that is, say, a B2B business, what the banks are desperate to know, if you go back to that first question about relationships, is what do I need to know about people? What sort of relationship do they want with me? So you've got to move. If you think back to maybe 20 years ago in retailing, and someone would say, why have our sales gone up? And it was always down to the weather. In retailing, it was either the weather was nice or the weather was bad. They had no real idea what customer patterns were happening, why people were coming to the store, when they came into the store. So if you think about all of the services that are needed around that area to understand the customer better, to provide a better service to the customer, so the customer can buy more of whatever the stuff is, either a business or a retailer, that's ultimately where the big volume of scaling opportunities exist. Because I think the capital flows now are sufficient that you'll find that the creation at the top end of the unicorns in the UK is almost matched the US over the last few years, and the US had a very strong 2020, which puts us a bit behind. But the number of unicorn businesses produced in the UK, right, is as much in 1 year as the rest of Europe is in 10. So, and then behind the unicorns are lots of other businesses. So if you put the customer at the heart of whatever your solution is and solve their problem, you'll find that will then allow the capital to flow. And it's not easy. It isn't easy. But that, I think, is at the heart of where your solutions are.
Anything to add from your side, Sean?
Yeah, I mean, I couldn't agree more. Like, I think the customer-centric nature of it is incredibly important. If you read Joel Horvitz's book, The Hard Thing About Hard Things, one of the things that he talks about in there is this concept of right ambition. It's like the wrong ambition is to think, hey, I'm going to build a company and it's going to make me a ton of money and I'm going to get really rich. A much better type of ambition is think about what the customer is trying to do, try to make your customer successful, your success deriving from that success, because that's a sustainable long-term basis for building a business. And I think that's just incredibly important.
Great. So we also saw that although investment is coming in, we also saw that the indications that early stage startups are struggling to get initial capital, which investors are more likely to go for more established, fast growth companies. Is this also something you are witnessing, David or Sean, if you'd like to comment?
I'm happy to go first. Yeah, it's a very mixed and inconsistent picture, I think, and it doesn't stay constant over time. And I think one of the things, though, that 2020 did was that it may well have pushed some of the funding slightly up the chain rather than down the chain. So all funders, when they're looking for, it's not so much necessarily they became more risk averse, but what they're looking for is some pattern of will it scale. So and to do that, then people in investment are basically their pattern readers. That's what and then you've spotted a good pattern, and then you can back it, and you think it's going to scale. And if you've got no pattern to follow, so the very early stage businesses, which rely very heavily in the UK on a mixture of some government funded initiatives and government supported ones like EIS schemes, their investment slowed down during the course of last year, and there was probably a greater move up to the scale up. Now I work in the scale up industry, so and actually our level of capital deployment was slower in the first half of the year than it had been previously, and it accelerated in the second half of the year. But that was a function, I think, of the disruption that was caused to the process by which money was deployed. You went through a 3-month period of working how you were going to do things. Like what we're doing today is now very commonplace, but actually putting people onto Zoom, working from home, and setting all that, there was a pause for about 3 months, and 3 months in a 12-month period, of slowing down capital flow produces actually a longer delay as people sort of restart up again. So everybody suffered a bit, I think, at that stage during the course of last year. What I think is very interesting at the moment in terms of the behavioral side is that not just that a number of kind of holiday websites collapsed almost on Monday evening as people decided that anything after the 17th of May was fair game and were trying to book abroad. But the same desire, I think, exists in quite a lot of communities. There is quite a lot of uninvested capital. It doesn't mean that your business will always be the one that accesses it, but there is an appetite for return. And the difference between, I think, the dip that we've had in 2020 and say 2008, and then go back to when the tech bubble burst, is that immediately after those two dips, there was a paucity of capital looking for return. That's what the problem was. There wasn't enough money around. At the moment, there's a surplus of capital, which in part is driven by the wealth creation over the last 10 years. Different webinar, different day about how that's being distributed. But that wealth, there's a lot more wealth creation coupled with still a very low interest rate environment. So capital's hunting for return. So that means you would hope that 2021 and beyond, back into this year into next year, I don't know whether we're going to get another sort of roaring 20s like we had 100 years ago after the last sort of pandemic. But there's no doubt that there's some quite good characteristics there with lots of people with ideas and probably, hopefully, desperate to come out. Human beings are themselves social animals who've been in for 12 months. So maybe there's a creative burst coupled with some capital. So you can feel quite positive about the future.
Yeah, and I'd like to it's kind of interesting. Obviously, David's opinion is much more credible than mine. But like the thing that I feel about this is that it seems to me that pre-crisis, or this is another example of how the crisis has maybe accelerated a trend that was started before. But pre-crisis, there was a sort of a shift away from this idea of just taking a business model that was just inherently disruptive, putting massive funding into it, and then figuring out profitability over time. And that's, I would sort of characterize it as the sort of Uber, WeWork type of business model where you've got something that is it's very cool, people really like it, there's definitely something interesting there. However, it's like not obvious that it's intrinsically profitable, and those models were very, very heavily funded just because they could achieve huge scale. And then people realized like actually profitability is kind of important to a sustainable business. And so there was a shift away from some of those. And then I think when the COVID crisis started, I think in a way that trend is maybe accelerated because of the trend following type behavior that David mentioned, where people want to spot patterns. And even in smaller companies, obviously those are huge companies raising a ton of money, but even in smaller companies, I think there was maybe a trend towards like, rather than just betting on disruption and scale, or disruption and scalability for a small business, there was a lot of emphasis on, can we see a profitable future for this business in the reasonably medium term? Doesn't have to be like immediately, And so there's probably a change in the way funding is being allocated towards different kinds of businesses as a result of that.
Talking about trends, that's really interesting, Sean. Do we have any early indications of what these emerging trends are going to be in 2021 in terms of investment?
Yeah, I mean, it's very much straws in the wind, and my guess is that whatever I say today will be wrong in 6 months' time. But if we think that what you've got is there's been a slight definitely a dampening of economic output last year, even though that's going to bounce back a little bit. That generally speaking, the likelihood of the combination of COVID-19 and the transition period to the new trading relationship with Europe will put some ultimate dampener on the economy. Then what generally tends to happen there is businesses themselves become focused on those two things. One we've talked about a lot, which is delivering stuff to the customers, and the second thing is driving cost out of their business to become more efficient. So if you look therefore at the balance of things that we see that we're investing in the VCT industry at the moment, you're seeing a lot on driving sales growth, so sales management, sales funnel tools, data analytics tools, all of those things about how do I make my sales process a better, slicker, faster, quicker. And all of that is to do with digitization, in every single way that we're looking at. And interestingly, Salesforce at the end of 2019, they did a map of the world as to where they ought to apply their capital, and the UK was one of the 3 places that came out in the top 3. With for every pound spent on Salesforce produces an extra, well, actually use dollars, but every dollar spent on Salesforce produces another a $5 multiplier effect for the economy, and because the adoption rate is so high, because you're connecting people and customers much more quickly. The other thing is a general efficiency tool thing. So apart from the big trends that you've got, so and perhaps the biggest trend that was in existence in this world was the movement from on-prem to off-prem and the development of the cloud. That's accelerated, not the least because lots of finance directors and big businesses now realize that A, it's quite tricky, it's not as tricky as they thought, and B, it takes out all the cost. So those two combination of things mean that what you're seeing is everything to do with cloud-based. So businesses born in the cloud have a structural advantage with those that don't. And those areas are the ones which are taking in capital at the top level, and there's lots of tools and stuff that hang off the back of that. And the other thing that you've just seen as well, which is not unusual but quite interesting, is the healthcare supply chain. So it's not really a today tech, but if you look at where the tech has gone, last year's pandemic and then the speed of vaccines have come through, is an area that you're seeing huge investments in. And where we talk to businesses that analyze, provide, and process data plays a big part. You think that when classifying DNA first came out, and the cost of analyzing one strand of DNA at that point is now 10,000 times cheaper than it was before, and that has made it much more, in the UK speak, capital efficient to invest in, which means that the healthcare channel, right, is now a place where you'll be able to see, hopefully you're taking years out of the development of things that were in life sciences. So that area, that's much more specialist. Not everyone's geared up to invest in that area. That's another area that you're seeing that is developing. But it has things, if you've got a data tool embedded somewhere in your fintech app, don't underestimate what else it could do.
Yeah, and just to build on that, like obviously data and cloud are things that I know intimately. We're fully cloud enabled. We don't even have any kind of on-premises capability. So all of our systems are in cloud. And I think data and analytics are massively valuable and are increasing in value. And it's interesting you mentioned Salesforce. Like one of the biggest acquisitions Salesforce did last year, Tableau, data visualization software. So like it's clear that they think that that's a very, very important part of the future of business. And I think that trend is going to increase. Also, when you think about data, there's all kinds of very unglamorous services that sit beneath that, right? So if you're, a big bank, you might totally have got the cloud religion and thought, okay, I want to get all my stuff in the cloud. I want to use some fancy technology like Vertica or whatever, Redshift or something to do my analysis. But I've got a bunch of clunky old AS400 systems. I've got a core banking system that was written in the 1970s in COBOL. I need to get all that data into some sort of sensible format so I can actually do something useful with it. So there's like a ton of potential for businesses that just tackle some of that data workflow, data extraction kind of, and it's not data warehousing in the way that people talked about it sort of 15 years ago. It really is like, data curation to get it all into a decent spot so you can do proper analytics and so on. And I think there's a lot of potential there as well.
Great. There's a lot of early indication and trends there. Thank you for that. So another factor I've been hearing quite regularly nowadays is the ESG factor. How does that play in terms of investment, and how do you guys see this taken as more prevalent in the future? I mentioned this because I read the article about a certain coral-coloured challenger bank founder talking about aligning culture with values leading to sustainable profits, not just profits but sustainable profits. What are your views and opinions on culture, values, and the ESG factor?
So I'm happy to go first. So I think it's incredibly important. Like, our founders talk about our values all the time, literally in every single meeting. These things are mentioned. When we talk about things, we tie them back to our founding principles and so on. And I think that's very important, because one of the things about people is you need to repeat messages to get everyone kind of marching in the same direction. You can't just say something once and assume that everyone's gonna get it. And also you have to live your values. And I think with ESG, it's a really good example of, like, if you speak to anyone in business over coffee, everyone knows that they need to be more ethical, more sustainable. It's important. It's important because people want to have a positive social impact. And even if you don't care about that, it's important because you don't want to look bad by doing something that's incredibly unethical, unsustainable, or whatever. So it is very important. The way that, like, when the rubber hits the road, what we're seeing is, for example, you're getting banks where previously they would make a lending decision purely on, the grounds of the cash flow of the business, debt capacity, and so on. Now there's also an ESG component. Like, am I happy that this borrower is got a sustainable business from an environmental point of view? What about social impact, etc.? And so banks are starting to think about from that perspective. Likewise, as a vendor to banks, we have to demonstrate our credentials in that space. And I think that's important. I think there's no reason for, we're not in an industry where it's hard to be sustainable, and therefore there's no excuse for us. If I was an extraction company, it's much more difficult. So I think, it is a very important trend, and it's not a trend in the sense of just being fashionable. I think it's a very important direction for us all to move it towards, because one of the things, if you study economics, everyone maximizes their utility, and that's normal. You can't expect people not to do that. And there are lots of environmental and social factors that, historically people have thought are externalities. So I don't need to worry about pollution because the government takes care of pollution. So if I run a chemical plant, I can just pollute as much as I like. That's obviously just terrible for the long-term future of the planet and for us as a society. So businesses are starting to realize actually they need to take care of these externalities. It's important.
Yeah, I'd echo that. I think it's an interesting area, because I think that there's an overall trend is towards a much more managed element of culture. It's sort of Maxim, isn't it? what gets measured gets managed gets done. And trying to quantify and qualify culture is something that has started very embryonic, probably only 10 or 15 years old in most advanced businesses. But there's an overall link, between what we think is probably positive cultural behaviour and positive financial return. And in America, it's all around the conscious capitalism sort of ethos, which has been around for maybe about 15 years. And there is undoubtedly a relationship with the better your culture. So anything from that will be, if people like to work there, you set turnovers better, you get better, you get more out of the people, they're more productive, they're all happy. But actually what produces that culture are things which can be very different. And the same is true in terms of your attitude to ESG, which is about not just, it isn't about recycling your paper. It's about the wider thing, about how you treat your employees, what your impact is on the wider community, and how you envelop that. That does not mean, though, when we talk about this, that you don't find examples of extremely bad culture still doing very well, and you read about those all the time. And that's certainly in certain areas where you've got very driven individuals, sometimes at the top of businesses, who drive down the list and they set a culture. That doesn't mean, and you've seen some of the very high-profile cases of that. That doesn't necessarily mean that, unfortunately, the business won't be successful, which means that as a result of it, that type of behaviour for some is still a role model, and it's still in the system. But I think overall, in the end, it is the money, which is what I think what Sean was saying, it is coming with certain conditions now. Increasingly, very large institutional investors are looking at, almost ahead of most other things. If your UK pension fund will be asked first about what our ESG policy is, not about our financial return. They do want good financial return, but they want to make sure they're going about it in the right way. Now, it's still evolving, but it doesn't mean that I think if you're at the forefront of that, as what I think is a general overall trend, it's to be onto that rather than at the back of it. And particularly in the fintech industry, I mean, our analysis shows that the perception is that the average age in fintech is quite low. It's actually not as low as you think in terms of development, but it's definitely lower than the average. And there's no doubt that there is an improving thrust in this area, and it's a big hook for those coming into the industry that they look for their employers, ones that have more positive rather than negative attitudes in this area. And therefore, it's best probably to have one, because you hopefully then that's part of retaining your best talent. None of it's easy. It's not absolutely clear. It's a very difficult area, and particularly when you've got to still make judgments about if I am supplying a bank which lends money, and it lends money with whatever service it's providing them, and it's lending money to parties to the gambling industry. How do I feel about that? It doesn't mean that the judgments are absolute, but I think just the fact that you're thinking about that and how it approaches, I think is a good thing.
Great insights from both of you to that is something that's more prevalent, and it's not just a fad. And I want to take us now, David. You mentioned earlier that there's a two-part acceleration factor. One of them was the pandemic. Now, I want to touch briefly on Brexit and what life outside the EU has meant for UK fintechs. These questions go out to both of you. Please do step in where you wish. First one is, in terms of financial services in general, are either of you concerned about the impact of Brexit?
That's great that we've got this question with 4 minutes to go, so it's only a really short answer, isn't it? The answer in the very short term is yes, because there is a short term and a medium term element to it. And the short term, the financial services sector has been left out effectively of the detail of the trading relationship, which means that if you are sat here at the moment, you are facing significant levels of uncertainty about, particularly if you have trading relationships, or your supplier business, the broker and the commodity businesses, all the sorts of businesses at the moment, trading inside Europe. The small businesses, if they've not already got European trading platforms, have stopped, and they will stop, and they're not. It looks like they're not going to reach agreement over 3 months because there's a lot of posturing going on and not much negotiated at the minute. So the very short term, it's a bit like last year, where it's pretty hard to actually talk about what consumer behaviour was when a lot of them aren't consuming what they were doing before. It's really hard. It's really hard for certain parts of the fintech sector at the moment to actually plan medium term, and we don't really know what the trading outlook is going to look like for the immediate part of 2021. So I'd couch my answer with the first caveat being, in the short term, it's a mess and it's really hard. And it's known as a priority, but the process of getting to the answer is going through a whole series of machinations at the moment, and time scales don't, from the outside, don't appear to be as important as you would think. You actually think you really need to sort this, and actually, but if it takes 6 months for you to get into the world, this many businesses particularly. So beyond that, it does depend on what the trading landscape looks like. But assuming that you can trade and the UK can maintain its very strong competitive advantage, some of it will have been lost over this 6 month period. It won't all bounce back, right? Then ultimately, then the trading relationship will be what the trading relationship is, and it won't be the big thing that we talk about. It may or may not be that any different. It probably shouldn't be any more of a drag than it already was. And whether it's a benefit, I think, will be down ultimately to everybody, to how we operate and trade, because it is one of the truly global industries that we have. If you're sat talking to a manufacturer in Sheffield who currently supplies a UK-based product, right, it's going to be very hard saying what you need to do now is go and have a new contract in Brazil or something. He's got no idea how to do that. The fintech industry is global, so it should be able to take advantage of that position.
Yeah, no, I agree, and very briefly, I think it's shifting a lot of the risk. So because of the nature of the problems that David mentioned, where there's so much uncertainty, for example, what we've seen with our fintech clients is our European clients want us to take all the risk. So they basically all asked us to novate all of our contracts to a European entity so that they deal with the European entity. We have to take the risk of sort of regulatory arbitrage, if you like, between UK and Europe. And because you're a small company trading with a big company in our case, there's not really much we can do about that. So it's definitely a risk. I do think it creates opportunities. And I think, because of these things, some of the larger banks, for example, will pull back from the UK market to a certain extent because they're unsure. And I think that creates opportunities for challenger banks. So I do think there will be, it's not all bad news, but I do think there are additional risks and additional opportunities.
I think we did very well there and keep Brexit brief. But there's one thing I need to get in there, and it could be a straight fire question. Do you see any challenges with talent acquisition?
Yeah, so I mean, we're already seeing situations where we have to get special visas for certain people, and they have to be sponsored by certain people and so on, in order to keep some of our existing employees, let alone like hiring new people, just because their work status was completely settled before and now it's not. So there's definitely an impact. I also think at the margin, sometimes additional friction stops people from doing things. So for example, if you're a person, very smart programmer in Berlin or whatever, and you've got an option of going to London or going to New York, and it's harder to go to London, then you might just go to New York. So I do think at the margin, it's going to impact certain people's behaviors and reduce the talent pool somewhat. I do think the structural points that David made about the advantages of London in the long run will mean smart people will always want to come here. People will always want to start businesses here and so on. So hopefully in the long run, the impact shouldn't be too bad because, smart people will want to come and work for the startups that are starting in London.
And again, I'd agree with that. It's another short-term, long-term thing. Short-term, it is an issue again because previously London and the UK was a melting pot which pulls from lots of different places, and it's a little bit of uncertainty at the moment. And even if the regulations haven't changed, I think it's exactly right. If you're sat outside the UK and you're not quite sure whether you're welcome or not at the moment, you just need to get some reassurance. So there's a short-term hiccup there. The medium term, the thing that could dampen it down is the political one, which is that if we don't really nail you do need to be able to have still a cosmopolitan grouping at the moment. And saying all these jobs are open to British people is not going to be a short-term fix. Which is the government. If you want to do that, you've got a whole different seminar on the education piece, widening the talent pool, widening the gender pool within the talent pool as well. All of those sorts of things. Those take time. So don't put anything politically in that restricts movement of labour in the short term, and that you could do a lot of damage over the next 10 years. And I think it's not part of what we're calling the balance, but I think there's a chance that the government could nudge it slightly the wrong way on a broader overarching sort of thing about restricting movement and making statements. And I think what the industry's got to do is just to keep banging on and make sure it lands its points about why having talent coming in from around the world at the moment into this sector is overall net good for UK PLC and isn't displacing UK jobs, which is at heart what a good chunk, a reasonable chunk of the current regime believe.
Great, thanks both. So that moves us on to the final section. What lies ahead then? So finally, what is the one thing to watch for in 2021? Could be a company, a vertical, a region in the UK. What does your crystal ball say?
Well, I've got my first vaccine on the 6th of March on a Saturday, so that one I know is coming up. So my wife is calling that Freedom Day, although I'm not entirely sure it is at the minute. But I do think the result of that, it looks like the UK vaccination programme is going to open up things, perhaps slightly more in 2021, certainly in the UK, than they otherwise would have done. So I think, as from what was said before, I think those trends that we saw before are the ones that you will still see, whether it's in sales management, whether it's in data, whether it's in the emerging, fintech will still continue to be strong. As will, I think, what you'll find is another trend is you'll find lots of other sectors adding the word tech on the end of them. Insurance tech. We've not yet had sort of paperboard tech, but I don't know what it's going to be. But I think you will find that actually the application of technology in all sectors is going to continue, and I think that is the overall trend, which is a positive thing, because it means it's a good thing for investors because there's plenty to invest in. If you're an investee coming to us, it's probably not quite as good because it means that not everybody gets the funding that they think they deserve and want. But
yeah, so just to double down on what David just said, I think we all know that 2020 was the worst economic performance for 300 years, like in Britain. It's hard not to be gloomy about that, but in actual practice, like what history's always taught us is that great businesses come out of these types of situations, and I think we will see the creation and growth of some really, really strong, innovative, excellent businesses. What we need to do as a fintech community is really put the customer at the center of what we do, and like really think deeply about what our customers need and what their end customer needs are, so that we're helping them solve their problems, and ultimately that's going to help us to be successful.
Great, thank you both. And now I will take a final few questions from our audience. We have one here. Don't have a name to it, but it says, do you see one killer app platform that does everything for bank, fintech, or amalgamation of apps? If the latter, how do you see the sharing and interchange of data to get one holistic view?
Yeah,
that is a
so I have a strong opinion, so I'm going to jump in. So I think this is a very, very important trend. So, which is like in banking, it used to be bank as a monolith, and a bank would have, one IT system provider provide everything for them, and then they acquired another bank, so then they'd have two, and then they'd have three or four, and you'd have all these kind of very, very inconvenient mishmashes of things. So I think there's been a trend towards bank as an ecosystem where banks want to bring in different vendors, do certain things in-house that they're very good at, and then use providers for certain other things. And they rely on a certain Darwinian effect where they can just replace a certain provider with someone else. I think data interchange, as your questioner said, is key to making this work. And we will see a rise of APIs, standard data interchange formats, etc., so that all these apps and so on can play together nicely, and systems. I do think that, so far, if you're looking from a consumer perspective, these kind of banking amalgamation apps, I'm thinking things like Yolt, things like that do open banking and so on. They've sort of struggled to retain interest. Like you install them day one, you get all your bank accounts in it, and then you're like, okay, now what? It doesn't really sort of like do very much. So I think within a bank, there's a tremendous potential to this ecosystem approach. I think broadly, it remains to be seen where the value lies in an ecosystem like that.
Yeah. Okay. And I'll give you the completely equivocal answer. So I'll give you the answer to that question. In my view would be no and yes. Because I suspect it's a bit like I suppose any market and an evolution is developing. So you will get different applications in different areas that are solving different or providing different services and solving different problems for people, and there will be emerging winners in each of those sectors. So so initially the trend to the one, which is very much kind of a lot of what you see behind at the moment, and it's very become individually focused rather than community focused in many respects. That trend will help drive. I want to do this here and that there, and the other one over here, and I don't want to put all my eggs in one basket from a consumer perspective. But as the market develops, that might be over 5 or 10 years or 15 years. What you might find is that, of course, ultimately, two things happen. Markets in the end, despite everyone's best efforts, tend towards oligopoly. They tend towards a few large winners operating. So you'll find it might well all consolidate, but the timescales will be quite large. So I don't know, personally for me today, I wouldn't be going out there to try and develop one killer app that did everything. Because not unless you're starting at basically the age of my son, 25, and being prepared to wait until my age to get to see the full adoption of it, which is 60. But actually just do stuff that the customer wants, and then eventually the market may well consolidate an answer, because what it will do if you try to do everything like that, it'll slow down your speed to market of the thing that you could have done fastest. And what you want to do is get there quick with it and demonstrate that people want what you've got.
Great, thank you both. I've tried to keep Brexit as brief as possible, but we have a question come in about Brexit. So the question goes, do you think the UK PLC has understood the financial services sector when it comes to Brexit? I personally don't think it's good for fintech as part of the wider sector. What are your thoughts?
So leading the witness question, I'll go first. Well, it's interesting as to kind of what who or what is UK PLC, because ultimately UK PLC itself is just an aggregation of a series of individual activities. That's all GDP is. That's all UK PLC is. That's all any country is. So the answer is it depends, I think. So if UK PLC is meant to be the government, as a representative body of that at the moment, I think it's a bit, there's a recognition that financial services is important, but not necessarily what the impact of the trading position with Europe will be on that. And I think some of the KPIs that they're currently using are probably not the right ones, which is just what's been the job migration this month. Oh, it's not as bad as we thought. It's okay. So I think, you know, they've got the wrong KPIs at the moment. That's where maybe the government is not on the case as much, which is why the industry is working very hard at trying to make that case, get this sorted, and then let us go back as much as possible. What the government is fond of, though, is light touch regulation where it can manage it. Not usually very good at implementing it, but it's a principle that they want to go with as lighter touch regulation, and maybe providing support, you know, at where the funding gaps are, you know, in the ecosystem. What it's trying to do with the review of state aid is to give itself a freer hand to provide that support. Now, whether that's a good thing or a bad thing, it's difficult to tell, because governments have not always been great at picking the next generation of winners. But that's what they're trying to do, is to change the state aid regime to have an equivalence in terms of working with Europe so that we can operate and trade with them, but give us enough freedom to be able to go and develop the businesses that want to be able to develop on an international basis. So it's a really, as ever, there's a few constituent components to it, and overall, you might not achieve as much as you thought you were going to do if you get the short-term bit wrong, and they're not quite on it, I don't think, in the short term at the minute. So in that sense, I'd certainly agree with the sentiment of the question, and particularly around government action around at the moment, they just need to get on it a bit more.
Yeah, I agree. And like, just keeping it brief, I mean, there's no question that the government, different parts of the government and the civil service and the treasury and so on, have really, the DTI and so on, have really tried to consult widely leading up to Brexit and so on around the trading relationship. I know that I was, you know, consulted several times on different topics and so on, and I'm sure most other business leaders were. But you know, the impacts are incredibly broad. It's very, very, very hard to tell in the long run how everything's going to change and what the net effect is going to be. I think, as David said, like UK PLC broadly is just a bunch of different people who think all kinds of different things, and so there isn't, you know, one concerted view around financial services or anything else for that matter.
Fantastic. I think that wraps up our Q&A, as we're now approaching our last minute or two. So thank you very much for your questions, and thank you to Sean and David for the insights and the engaging session today. As a reminder, we can now move on to the virtual networking once we close the panel discussion. Please stick around, meet each other and the speakers too, and ask more questions. Thank you, and goodbye from us. Have a good day, guys.
Thank you, and keep innovating.